Welcome to Good Money Guide TV. We're here with Ryan O'Doherty from CMC Markets. We're going to have a chat about CFD trading, contracts for difference trading. What they are, who they're for, what you can trade, what are the main risks, the main benefits, and also some top trader mistakes and how to avoid them. So, Ryan, hello. How are you? Welcome.
Thank you for good. Nice to see you.
Thank you for joining us.
Yeah, no problem.
So CMC Markets, you've been with them for many years, many years now. So as well as spread betting, CMC Markets is also a CFD broker.
Yes.
Do you want to briefly talk us through what CFDs are? And how they can be used.
Yeah, well, CFDs is more of a global product. So unlike sort of spread betting where it's isolated to the UK and the Irish market, CFDs is available globally. So we have a number of clients in regional areas. Now, CFDs is basically contracts for difference, and it really is in the name. It's a contract for the difference in price of an underlying security. Now, that underlying security can be anything from indices, FX, commodities, treasuries, cryptocurrencies, etc. So it provides a way for clients, and a very popular way, to trade the financial markets on a multi-asset basis. But it's done on leverage. So clients only need to put in a small amount of their own capital to take out much larger positions. And so margin starts from as little as 3.33 for FX and moves up to 5% for indices and 10% for commodities. So for clients that don't have enough money necessarily to trade much bigger positions like a FTSE or US, but with physical or futures, then you can actually trade them via a CFD product.
Okay. And obviously, CMC Markets is a London-based broker, but CFDs are a global product. So who would you say within the investment landscape, CFDs are an appropriate product for, of your client base? What's a sort of typical trader look like?
Yeah, a typical trader. I mean, with CFD trading, it's a lot of traders that have come from, other areas that they've traded previously, or they've done physical trading and then coming into CFD trading. It's a very familiar way to get into CFD trading or trading short term, because you trade in number of units, so it feels familiar. Unlike spread betting where it's pounds per point, which is a little bit alien to some people, the trading in units is a much easier concept for clients to get to deal with.
So if you want exposure to 10,000 shares of Vodafone, you buy 10,000.
Buy 10,000, exactly. Where with spread betting, you'd be doing £10 a point, which is a little bit confusing for traders that have done that in the past. And because it's a leverage product, it enables you to buy or profit from a rising as well as a falling market. So there's a lot of clients that want to take advantage of that. Volatility in the markets, is always there, and opportunity presents itself. So being able to profit from both rising and falling markets is a very important tool, and that's what CFD provides.
Okay. Super. And in terms of what your customer base trade, what would you say were the most popular assets or instruments that your client base will trade on CFDs? Yeah,
CFDs very much, it's equities to start with, but then indices and FX are probably the two major products that clients trade. The DAX and the UK 100 and the US 30 are very popular products. They give a diversified way for clients to get access to the market. So for a lot of people, they don't necessarily know which individual stock is going to go up or down, but they have a general feel as to where the market's heading. They read the newspapers, or they get a general feel that the economy is doing well or badly, and then they'll say, well, this is a great way to get exposure without having to understand the complexities of individual products.
And of course, it's a nice sort of risk management tool as well, because if in fact you don't know where the market's going to go,
absolutely,
you can run a long-short portfolio on equities as well, can't you?
Absolutely. You've got the hedging capabilities of these types of products is great as well, because you can profit from a falling market as well as a rising market. You might hold equities, for example, in a share portfolio, and you feel that the market might have a bit of a pullback. Well, you can go in and you can actually short the CFD on the market generally, and so you can sort of hedge that position and sort of wait for the market to fall, and then get rid of your short position on the CFD, and then continue on with your equity position.
Yeah, it's a good risk management tool. We always used to do that at Investors Intelligence when we run our long-short portfolios. If you're long some fairly weighty FTSE 100 stocks, you always run the risk that those stocks will be pulled down with the general market, so you can use an index CFD.
Yeah, especially if you don't want to sell them at that point, you don't want to realise a profit or a loss on those particular positions. Then using a tool like CFD to hedge is a great.
And it's quite a nice way to pick individual stocks you think may outperform the market or underperform the market, whilst being sort of fairly agnostic to to the overall moves. Should we just quickly have a look at your CMC CFD trading platform and just talk us through the assets that are available on it?
Yes, certainly. I mean, this is a basic CFD trading screen, so it's customizable, so you can set it up the way you like. But what I've got there on the top left-hand area of the screen is just some quote panels of some of the major markets, so the US 30, DAX and NASDAQ up there on the top. And then down the bottom, you've got sort of crude oil, copper, silver, and then some currency pairs like euro, dollar, and cable down the bottom. So that gives me easy access to what the prices are. I simply click one of those and the order ticket will load, and you can instantly place a market order quite quickly.
And that's your bid offer spread, isn't it? So
they're
your prices rather than the underlying market.
That's correct, yes. Well. So, and we're very transparent in regards to the cost. So you've got the spread actually in the bottom of that quote panel. So you can constantly see what the spread is depending on the liquidity of the market. Some of those are fixed. So during market hours, for example, indice spreads are fixed. But clients can actually see what those spreads are, quite visible on the platform. And then on the right-hand side, you've got the charts. Obviously, for a lot of experienced traders, they like all their analysis and looking at chart performance. You've got the different indicators. But also for new clients, they quite like just being able to see charts, see what the general price has been doing over a period of time, and then they start using more of the tools later on as they become more experienced.
Sure. Excellent.
And then on the mobile side of things, because these are really important these days, roughly 60% of our trade volume is done on mobile. I've been in this industry for 14, 15 years, and it's really been the last 4 or 5 years we've started to see the balance tip towards mobile trading.
I've always found the shift to mobile trading fascinating, actually, because I can't make a decision on a mobile phone. I can close a decision on a mobile phone.
Yeah, well, we do see a lot of that. So you see a lot of people monitoring their open positions on mobile. They're out and about. They want to see whether or not the profit or loss is on there. But it's having access to it wherever you are and then being able to close it out. But also with sort of push notifications and these, being able to get information sent to you so quickly, you might be out and about, so you don't want to miss out on an opportunity. So you can easily go onto the mobile platform, place a trade. It's the exact same order ticket, looks exactly the same, it feels the same, and you just execute on the go, which is quite a powerful tool. But yeah, probably about 3 or 4 years ago it tipped, and we did more trade volume on mobile than
interesting. Interesting. Okay, so in terms of CFD trading, let's just go through the pros and the cons. What's good about CFD trading and what's bad? What do clients have to be mindful of?
Yeah, so I mean, obviously when trading on margin, there's a risk involved. There's a sort of a double-edged sword in some ways. You can only have to put a small amount of your own capital in to take out a much larger position. So your exposure is on that net overall position. And so you can amplify your profits quite quickly, but you can also amplify your losses. So it's really important that clients put risk management orders on their trades, because some of that volatility might happen while you're away from your screen, and so you can lose money quite quickly. And with the new regulations that have come in, you can't lose more than your initial capital in your account, so you're protected in that.
That's for retail customers, not for customers that upgrade to professional.
Yeah, so there are restrictions depending on what type of client you are, retail or professional. But if you've got more money in your account, you can still lose more on that particular position than you put in. So it's mindful to put the stop losses in, put some risk management on. So that's one of the risks. One of the differences between CFD and spread bet trading as well is that CFD trading, you're trading in the underlying currency. So depending on where you're trading, so if you're trading in the US market, for example, you're trading in US dollars. So you have a currency conversion risk, I guess, in some ways. So once you close out that position and you return it back into pounds, then there is that transfer. And if the pound had gone down or up in value, then that's obviously going to affect your profit and loss.
And currency exposure in particular is something that people don't understand or bury their head in the sand and refuse to.
Well, I think that's probably the way to think. I think they probably know it's there in some ways, but if you're trading spread bet, you don't have that. It's always pounds, so you don't have to worry about that. But on CFD trading, you do, and you've got to be mindful of it. So it's a bit like going on holidays. You're always constantly looking at what the exchange rate is for holidays. You should be doing the same on.
So what happens with currency balances with CMC, for example? So if I'm trading the FTSE, it's not an issue because it's a sterling denominated product. Right, but if I'm trading the Dow, for example, and I have an amount of profit or loss, what happens to that? Does it sit in dollars?
No, it'll automatically convert into pounds once you close the position at the prevailing sort of spot rate. Plus, one thing when you're transferring across, then there'll be the spot rate plus a small percentage on top of that.
So there's no danger of running a deficit in one currency and incurring interest. And say, for example, I'm a customer who a lot of customers have their favourite products. Some people like to trade the DAX, some people like to trade US equities. Could I have a US denominated sub account for trading, or am I always going to be subjected to?
There are sub accounts with the potentially we can be set up. So if you would rather trade in US dollars, for example, there are accounts out there that allow you to do that. So you've got the option. So more advanced traders that want that sort of capability, then they can look for that.
Okay, super. And let's just take a quick look. Over the time you've been at CMC Markets, traders that don't make money, it's a sort of well-publicised thing.
Yep.
What would you say are the top 3 mistakes they make?
Yeah, definitely.
And what can they do
to avoid them? Yeah. I used to run a whole range of education courses based on trading and trying to learn the psychology and the risk management side of things.
This is for CMC.
Yeah, for CMC Markets. And one of the areas that's the biggest is that clients go on, they feel like it's a great opportunity to make a big amount of money quite quickly.
Especially with the Instagram.
Absolutely. There's a whole range of people trying to promote that you'll make $1 million within a day or something. Those sorts of claims, but it's really important that clients do their research. Understand the markets that they're going to trade, because different events affect different markets. So, fundamental news such as non-farm payrolls or CPI figures coming out will really affect, let's say, the FX market. Yeah. Unless you know that those events do, then you won't realise why the price has gone up or down in value, and so that can affect your trade. So it's really important to understand what moves particular markets. So doing that research. The second is really just about having a strategy. So making sure that you say, well, how much am I willing to risk? Make sure that you say, okay, that's the limit, and then put your stop losses on the trade, so that when the markets move, we'll automatically execute a trade to get you out of that position. And you can use multiple different types of stop losses. You can use regular stop losses, which are there at a particular level. But if there is a market gap, so the market trades at this level and then gaps below, you'll get executed at the low one.
Sure.
So you've got another tool called guaranteed stop loss orders, which will then guarantee the price, and you pay a small premium for that. So
do you have trailing stops as well?
We do.
If the market's moving up in your favour,
it's a good tool. I mean, trailing stops are one of those tools that, as the market moves in your favour, the stop loss will move up, in a certain point range which you specify. And they're great once you're actually in profit. I prefer to place them once you're in profit, because sometimes the market can move up quite quickly and then back down quite quickly, and you haven't really gone through your whole strategy by that stage. So I generally would place a regular stop loss to start with. Once my position's in profit, I will then put a trailing stop loss behind it and do it.
It's actually one of the sort of fundamental rules of trading and investing is, you only have to read anything from any experienced trader or investor. There's there's a brilliant book actually called The Art of Execution. Have you read that?
I haven't read all of it, but I've read some of the chapters. It's
brilliant. And the whole, I mean, you can literally boil trading strategy down to run your wins, cut your losses.
It is. I mean, risk to reward is one of those features where you say you're willing to risk £50 to make £50. It doesn't make a lot of sense to me, because there's trading costs and all those sorts of things involved. So you're looking at a risk to reward strategy of at least 1.5 to 2. So risk 50 to make, let's say, 100. And then over time, you only have to get, let's say, one of every 3 trades right to actually start breaking even. If you're more successful than that, then you'll start making a profit.
Sure, so don't be greedy.
Yeah, but it's a really good point about the book. So I think, one of the things is there's so much literature out there these days. A lot of providers provide it on their websites to a certain degree, but there's some great books that, clients should really have a look at.
And I think the chap who wrote that book was one of the biggest fund managers in the UK, I think the world. So he knows what he's talking about.
You would hope so.
He's not just some guy off the street.
Absolutely.
So that was 2, wasn't it? And third, what's your sort of third?
The third one is just not to overtrade. So things you kind of get bored sometimes, especially with trading. It's got that element of excitement. Where investment, you don't mind holding off and letting those positions run. But on trading, you're constantly looking for opportunity. You're looking at trades, and sometimes you'll get into a trade based on purely because you think, oh well, I just want to be in something. So don't overtrade. Always be mindful of getting in on a particular reason, having a strategy for getting into the trade.
Exactly. Yeah. No. Sometimes the best trades to be in cash. Really, isn't it?
Absolutely. Yeah.
Right. Well, Ryan, thank you very much.
No problem. It's a pleasure.
Thank you very much for joining us for this episode of Good Money Guide TV. We'll be back with something else to talk about shortly. Thank you.